Sure, I'll do that.
Visible?
Yes, it is.
Okay.
Yeah, we are live now.
Hello everyone. We're just going to start in a minute or so. There are a few more people who will be joining us, so we'll just take a minute to join and start. Okay. Hello. Good evening, everyone. So today in this webinar, we are going to talk about fixed income investing. Now, equity often gets the spotlight, but if you think about it, fixed income actually is a very good foundation that holds every portfolio steady, right? So today we are going to explore how fixed income is not only about safety, but it's also about strategy, about stability, and about consistency, right? And many times when we think about fixed income, we actually think of very conservative returns of boring products. But in current landscape, fixed income actually has evolved. It's offering not only just safety, but also great opportunities for diversification, much better risk-adjusted returns as well. So today in the webinar, we have Ritesh Agrawal with us, who is ST's in-house fixed income expert. He is a seasoned banker and a treasury professional with over 18 years of experience in various asset classes such as fixed income, interest rates, FX, and derivatives, both in India as well as in UK. Okay, so Ritesh, welcome. And so to get started, Ritesh, can we discuss about the role of fixed income, the role of bonds in our portfolios?
Sure. Thank you, Vivek, for introducing me, and hello, everybody. So I think fixed income in our portfolio largely has few features which make them very different from the traditional equity that we all invest in. First thing that comes to my mind is that it offers stability, more like a defensive ballast, with a low correlation to equity. It smoothens the volatility, so it reduces the or acts as a very strong drawdown control in case of mixed portfolios. Second, I would say the cash flows are very predictable, so you can use the predictability of cash flows to fund goals such as EMI payment, tuitions for higher education, such and basically do kind of a liability matching. Of course, fixed income offers a lot of capital gain opportunities in specifically in case where interest rate cycles appear to ease going forward. There are a lot of taxation advantage when it comes to fixed income securities. For example, listed bonds or notified zero coupon bond, they can deliver better tax return than the traditional fixed income FDs and debt mutual funds. At the same time, I would say it gives you a lot of liquidity and flexibility. A lot of staggered maturities helps you, to create some kind of a regular cash flows. In terms of when equity market is not performing well, it acts as a sleeve where you can park your fund temporarily before you are ready to invest back in equity. So these are the few role I would suggest which fixed income has in our portfolio. Uh, yeah,
Okay. And why do you think fixed income really matters right now? Because overall, see, we have seen a huge spike in interest overall in our products, also the fixed income products over last 1 years, because equities hasn't been performing well, and now we currently saw the inflation is also pretty low. So, talking about the current market context, what do you think, where does this fixed income fits in our portfolios, and why does it matter right now? Your
sh-
take on it.
sure. So typical fixed income instruments that we all know and widely prevalent in the market is the government securities, which are typically sovereign. They are risk free, issued by the central government. But there are various other fixed income bonds, like, for example, state government bonds or state government securities, as we call it. There are corporate bonds, bonds issued by corporates. There are tax-free PSU bonds, and there are zero coupon bonds. So, ideally, if we look at the entire India bond market ecosystem, close to about 226 lakh crore is the bonds outstanding in the Indian market. And the corporate bond market has grown, I think, close to about 10% CAGR over last 5 years. Uh, there is renewed interest in the investments in bond because of various initiative taken by the regulator. Now you have retail direct bond platform, you have platforms offered by NSE and BSE, you have platforms offered by various OBPPs. Now, why now? I think this question, I'll just share my screen. So I hope my screen is visible.
Yes, Ritesh, to me. Yes.
Yeah. So if we see the upper line, this is the Nifty Volatility Index, and the bottom line, if you see the line chart, it is the 10-year GSEC Volatility Index. So the GSEC volatility is much lower compared to equity. The realized volatility is less than 5%, whereas Nifty volatility would be close to about 18% in last 10 years. And the correlation between a 10-year GSEC and Nifty is very low. It has, I think, a correlation of zero point 0.2 over last decade. So if we add, let's say, 30% bond to an equity portfolio to bring it a hybrid or a mixed portfolio, it historically cuts volatility by close to 35%. And given the current landscape, it's offering about 100 to 150 basis points. So that's 1 to 1.5% point pickup over the top rated FDs. Over last 1 year, specifically in the latter half of 2024, we have seen the easing cycle by most of the central banks. The Fed has been on the easing cycle. RBI followed up the easing cycle earlier this year, and now the kind of policy rates are quite stable. So under the stable regime, I think there are more FPI flows that are coming into Indian market, and there's a lot of stability which will offer superior return compared to a traditional fixed deposit. Also, India as an economy, I think we are at a very sweet spot right now. The inflation measured by CPI, the headline inflation, is quite low. Last three prints have been lower than 3%. In fact, the last print was
Yeah.
1.5 or
And a half.
1.55%. Yeah.
Yeah.
And the growth projection is very strong. So it's FY26 GDP forecast is still at about 6.5%. We are one of the fastest growing major economy. So a moderating inflation and resilient growth will eventually favor bond market return.
Interesting. This is quite interesting. The way you explained that having maybe 30% of debt actually reduces the volatility of your portfolio by one third. Because what we have seen historically is if you hold a fully 100% equity portfolio, obviously when the market is going up, everyone likes it. But obviously equity is not, it cuts both ways. So when the market goes down and you see corrections of 20, 25, 30%, it's very hard to really stay invested. And that's the time when people who are fully invested, taking more risk than what they can afford to take, they usually uh, make those mistakes of selling out all equity funds at the lowest point of time. So I think it's very crucial to have a decent amount of debt in your portfolios actually. So now talking about these, how does one go about creating a fixed income portfolio? So in terms of the products that are available currently, there are wide majority of products that are available apart from FDs to debt mutual funds to directly investing in bonds. So can you please take us through what all are the kind of products that are currently available in the market in this fixed income space?
Sure. So if we look traditionally by nature, fixed income securities, there are two kind of cash flows. One is the coupon, which is usually fixed as a percentage on the face value. And second is the capital gain, which is the difference in price at which you buy and the price at which you sell. Now, and we all know that the market interest rate is inversely proportional to the bond price. I mean, that's how the bond mechanics typically work. Now, with this backdrop, if we look at the traditional approach, so the easiest and the most widely used approach to get exposure to fixed income is by opening fixed deposits in a bank, and that's probably most of the people are doing.
Yeah,
Uh, Second one would be investing in various debt mutual fund schemes. So there are a lot of asset management companies which are offering various kind of debt schemes where the tenor or the duration would vary from overnight up to 10 years. And you can invest in those various schemes and get some amount of return as a periodic coupon payment and some amount of return as the capital gain. So historically in India, fixed deposits and debt mutual funds are the ones where most of the people invest. But
yeah,
over last few years, we have seen new avenues emerging in. So I would take two examples here. One is
yeah,
purchasing direct bond. So basically, the investor goes and buys bond directly. And hats off to our regulators. I think over a period of time, they have done a lot of simplification, which
yeah,
enables users to invest in bonds directly. So, for example, earlier to participate in any public issue, the lot size was a lot higher, uh, running into at least a lakh or 10 lakhs, depending upon various issuer.
yeah,
But now they have reduced it to 10,000 rupees. So you can participate in a primary market public issue with as low amount as 10,000 rupee. And there are a lot of secondary market trades also happening where you can trade on NSE and BSE where the lot size is just 1,000 rupee. So this amount that I'm saying is the face value of the bond. It will trade at a premium or a discount depending upon the prevalent interest rate and the coupon. So it's just like you buy a normal stock. So you have a demat account by your demat account provider, which ultimately you will have either with NSDL or CDSL. So bonds, when you buy, bonds are directly credited to your demat account, and when you sell, the funds are credited to your account and bonds are debited from demat account. In addition to NSE and BSE, SEBI has allowed a lot of OBPPs, which are online bond platform providers like Golden Pie, Bonds India, Bonds Bazaar, where retail investor can create their login credentials and start investing in bonds. So, technically speaking, now bonds are available with a click of a button. You can just create your IDs and you can log in and you can buy bonds via these platforms. Moreover, I think the regulatory focus is also quite there to get more and more participants in the bond market. RBI has launched retail direct platform where a retail user can directly buy the government bond. So with help of more participant emerging in, it's becoming more easier for investors to buy. So that's like kind of DIY strategy. You do it yourself. You create an account, you buy the bonds, you have coupon payments, you decide when to buy, when to sell. But obviously, when it comes to fixed income, just like equity, there are few inherent complexities. So you can also choose to leave it to the experts to manage your bond portfolio. So you have the SEBI's fixed income portfolio management services. So it's a normal PMS, just like equity PMSs. It's a SEBI regulated discretionary account. It's more like a custom bond portfolio, but and it works exactly the way equity works. It's transparent ISIN level holding. You will see the actual bonds being credited to your demat account. If the bonds are sold, the money would be credited to your bank account. There are periodic reporting. You will have access to primary issues or block deals and secondary market. So these are few advantages of investing in PMS. Um, yeah. So now within the PMS also, you can choose the strategy you want to invest in. Uh, Largely, they will be centered around or focused around, I would say, three different strategies, but obviously this will differ from each PMS manager or each PMS fund. There is a conservative strategy, there is a aggressive strategy, and there is a strategy in between, like kind of a balanced
Yeah.
strategy.
Yeah.
So now, when we talk about conservative strategy, it's mostly for the people who would not like to see their capital at risk. Close to 70 to 90% would either be invested in AAA or sovereign. Average maturity would be close to about, let's say, 2 to 3 years. And a healthy, steady post-tax return between 6.5 to 7% is what one can expect. Balanced strategy is for people who would like to have some amount of capital preservation, but like to also participate in some amount of risk. So a typical balanced portfolio would have 50 to 60% in AAA, AA kind of bond, remainder in little lower category of credit bond, and you target a return close to 7.5 to 8.5%. So that kind of a thing. Then you have an aggressive strategy. So an aggressive strategy is where you invest typically in a lower credit rating, but they are still investable grade and above, which will be typically A or triple B with a longer duration. So about 4.5 to 5 years. The idea is you try to make more capital gain there through rating upgrades or when the spreads compresses. So these are the few, fixed income PMS strategies that are available in the market. So any framework you take, whether you take the PMS or direct bond, largely four things you have to, bear in mind. So one is the duration layer, how long I am going to hold it for, or how long should I invest at the beginning, whether the maturity should be staggered across or maturity should be bunched up together. So you have to kind of think about the duration layer,
Mm.
a ladder or a barbell strategy. So ladder is where you have uh, fixed maturity is fixed at regular intervals. Let's say every 3 months you would have some maturities coming up. A barbell would be you have maturities at concentrated along certain points in time. Let's say you have maturities in 1 year and you have maturities in 5 years. So, for example, if you need to fund your son's college education and you want to save money for that or invest that money in a safe instrument, probably you can invest, have a duration layer which coincides with the time you need to pay the fee for your child's education. Let's say 5 years from now, and then 1 year every year for, let's say, another 5 years. So you can have a strategy where you have the first maturity in 5 years, and then in 6 years, 7 years, 8 years, just as an example. Again, you can add a credit layer, like what, how much to invest in a particular issuer, what should be the credit rating or internal scorecard of that issuer. A third layer could be liquidity, how much to invest in very liquid instruments, how much to invest in instrument which you will buy and hold. So these are various decision points that one takes while investing in bonds. So Obviously, for individual investor, at times it may be overwhelming. So you then leave it to the expert. You leave it to your PMS manager to decide the duration layer, the credit layer, and the liquidity layer. So these are, few traditional and new modern approaches for investing or taking exposure in fixed income securities.
So, Ritesh, in terms of maybe comparison between bonds versus debt mutual funds, can you throw some light on it, the pros and cons of maybe on taxation, on returns, on risk? What are some of the pros and cons of investing in bonds versus investing in debt mutual funds?
So when we talk about investing in bonds and debt mutual fund, there are very different strategies that will come into play. So, for example, when you invest in mutual fund, you let the fund manager decides what tenor you want to invest in, what credit you want to take. But when you do a bond investment, you decide yourself, or you let the PMS manager decide it for you. So the debt mutual fund, I think there's largely a MTM or a credit event that one needs to be aware of. Uh, they are subject to market volatility, and also it depends upon the selection of the instrument by your debt mutual fund manager. I think the biggest difference when it comes to investing in debt mutual fund schemes vis-a-vis uh, a PMS or a direct bond is the taxation. So I'll just explain taxation here with an example.
Yeah.
So let's say we compare fixed deposit versus mutual fund versus bond and PMS. So assume a 7% return and a 30% tax slab rate for an individual investor. So when it comes to fixed deposits, one, the interest is taxed yearly. Two, it is taxed on accrual basis. And three, if a person is in 30% tax slab, the post-tax CAGR is close to about 4.9%, assuming a 7% return uh, on a fixed deposit. So one is you get only 4.9% post-tax return, and second is you have not realized the cash flow. Let's say you open a 3-year fixed deposit, so the and all the interest is accruing at maturity or will get credited at maturity. So you will pay tax without realizing the cash flows. So that's a play. When it comes to debt mutual fund, from April 2023, all the tax benefits of debt mutual fund scheme have been taken away. And now all the gains, whether it is the coupon payment or short-term capital gain or long-term capital gain, they are all taxed at slab rate. So again, assuming 7% return, the post-tax return is 4.9%. When it comes to holding the bond directly, either by direct bond purchase or via PMS, the taxation rule changes significantly. A listed AAA bond, let's say again giving same return of 7%, if you hold it for 1 year or more, the capital gain is considered as long-term capital gain, and now these will be taxed at 12.5%. So assuming again we have two kind of cash flows from bonds, one is coupon and one is capital gain. So assuming 70-30 ratio of coupon versus capital gain, the post-tax return suddenly improves to 5.27%. If we go for a listed AA bond, they typically yield close to 9%. Again, applying the same principle, the post-tax return goes as high as 6.77%. If we go for a listed A-rated bond, where typical YTM is 11%, the post-tax return can go as high as 8.28%. So a discretionary bond PMS, let's say the blended rate is 9% with a mix of coupon and short-term capital gain and long-term capital gain, one can expect a post-tax return of 7%. In fact, why go far? Our own STI Alpha fund, if we look, our net return after fee is 11.74%. It's all under STCG slab rate, but the post-tax return is 8.22%, much better than a fixed deposit or a debt mutual fund.
Okay, great, great. In fact, there was a question about ST's alpha, about its returns. So maybe I can quickly just share. It'll take a minute to share the performance of ST's alpha. So this is a fund that we have been running since 2009. This is a pure arbitrage strategy. And since 2009, as Ritesh just informed, the annualized net returns have been 11.74%. And the unique thing about this is it has the monthly liquidity without any exit load. And also every single month since inception in October 2009 has been profitable. So that is it has a unique track record, very, very successful track record. And this year also till July, we have done about 7.5% in the first 7 months. We are on track to do somewhere around maybe 13%. So even this year, we'll be able to reach annualized net return of about somewhere between 11 to 12%. So yeah.
So I think that's very incredible performance, Vivek.
Yeah, we get a lot of interest, and especially during this time when equity hasn't been performing for last 1 year, huge interest in this specific scheme actually.
Yeah. And
So
the fact that there has been no negative return month since inception, that speaks volumes about how well this is managed.
yeah. So Ritesh, now tell me, you have been in this space for now almost 18 years now. What do you think are the common misconceptions regarding investing in fixed income securities?
Yeah. So one misconception that I always hear from people I speak to is they ask me, is fixed income only for senior citizen? It's like a way to park your money for your retirement. So I would say probably no. Uh, it's an essential diversifier across all the life stages. Of course, when you are close to retirement, your equity exposure you would try to reduce and invest more towards fixed income securities. But as you rightly mentioned, last 1 year, if we look at the Indian equity market, hasn't. I mean, there are bouts of performance, but largely overall last 1 year return has been negligible. So in these times, if you have fixed income exposure, it helps you. It stabilizes your overall portfolio return. So some portion of your return you should always allocate, or one should always allocate to fixed income. Another misconception I always hear is that um, whether bond will always beat FD. I would say not always. Not always. But if we are talking about listed bond over a period of time, we have observed that they yield 1 to 1.5% higher post-tax return than fixed deposit. So banking also, there will be period or time period where the fixed deposit rate would be high. But if we look at the average of last 4 5 years, and in fact more so now, where a 1 year fixed deposit rate from a, let's say, a private sector bank or a public sector bank would be close to anywhere between 6.4% to 6.6%. A typical bond will typically deliver you 100 to 150 basis point higher post-tax return. I also hear a lot of people saying liquidity is a concern in bond market. Well, not really. Uh, Listed AAA and AA bonds are traded almost daily, and there are a lot of OBPPs, online bond platform providers, who are offering huge amount of liquidity. And even when you opt for portfolio management services or PMS, usually your fund manager will keep anywhere between 15 to 20% as a liquidity sleeve. So liquidity is not an issue. Um, One more I often hear is about credit risk. Can credit risk be managed, or where I'm taking too much exposure? So I think, like any other risk, credit risk can be managed through diversification. We have to diversify the portfolio. There should be some kind of an internal scorecard of which issuer to invest in. Some amount of cap we should keep how much of a particular issuer exposure you should have in your portfolio, and there should be real-time monitoring. So with this, credit risk can be managed. I mean, it's not something which cannot be managed.
So overall, if somebody were to construct a portfolio of bonds
Mhm.
and directly through these platforms which are offering bonds, like
Mhm.
in terms of diversification, what do you think is the number of bonds that he should go after? What's the typical, just to be rightly diversified? One thing that we see obviously in mutual funds is, and this is from our Gullak app that now people have started using, which has mutual fund X-ray. What we have observed is the average number of mutual funds people have is about 15, which obviously is a bit too high, right? People want to diversify, but then they go overboard and do a bit too much of it. So in terms of bonds, if somebody were to invest in these bonds directly, what's the number of bonds that you think is the right balance of diversification also? And overall, what do you think is the number there? Anything in your mind?
So before answering that, I'll put it this way: for any fixed income selection, there are two factors that one should consider. One is duration, and second is the credit risk.
Okay. So,
So,
Ritesh, just for simplicity, there are few investors who might not know these technical terms. Can you
mhm,
maybe explain these two terms in simple ways? What are these?
yeah,
And how does this impact the bond prices and the returns?
sure. So duration is, you can understand duration is what is my holding period. Whether I want exposure which is of 5 years, I will hold the bond for 5 years, or whether I want to hold the bond for 1 year, I want to invest now, get out after 1 year. So depending upon the tenor that is your holding period, or the time that you want to invest in that particular instrument, bond, you can have various duration like overnight, which is typically uh, somebody buys today, sells tomorrow. You have liquid funds where you invest in bonds or fixed income product which have a maturity in 3 months time. So you don't go overboard and invest in long tenor bond. Then you have ultra short where the maturity is between 3 months to 6 months. You have short where the maturity is between 6 months to, let's say, 2 years. Medium will be typically between 2 to 5 years, and long will be greater than 5 years. So you decide what is my tenor of investment. And the second layer is what is my credit rating. So what kind of credit I am going to invest in. For example, if you want to say highest safety, okay, I only want to invest in the highest safety bonds. So they are typically Government of India bonds or AAA rated bond. A typical example would be, let's say, SDFC Bank. SDFC Bank bond is rated AAA, which means it's we consider to be very, very safe to invest. Second would be double A category. So double A category still ensures very high safety. For example, Muthoot Finance or Samman Capital. Below that would be A, which is adequate amount of safety, like a lot of small finance bank falls under those category, or Ugro Capital. Then you have triple B. Triple B plus is usually considered to be low investment grade. And then you have below triple B like double B and under, which are largely speculative grade. So every issuer or every company that you want to invest in the bond, they usually get their credit rating done by credit rating agencies. So these credit rating agencies will go through their financials, will go through their business model, and a host of all other factors, maybe 100 to 200 in number. And depending upon their ability to service the bond, which is ability to make the interest as well as the principal repayment, they would rate them. They would rate each and every instrument that they have issued. And this rating will vary from AAA, which is the topmost grade, down to double B, which is the speculative grade, and below speculative grade is considered to be default grade. So there should be, it's like a matrix. On one side, on the top you have duration, and on the other side, the rows. So the columns are duration: overnight, liquid, ultra short, short, medium, and long. And all the rows are the credit rating: triple A, double A, triple B, double B. Now, depending upon individual investors' risk appetite, risk tolerance, the return expectation, the liquidity need, you can choose which matrix where you want to exactly invest. But a thumb rule, some of the thumb rule that we follow is you should not have more than 15% invested in a single issuer. So let's say if you are investing 1 lakh rupee in bonds, not more than 15,000 you should ideally invest in one single issuer. You should have at least 7 to 8 different different issuers if you want to go to the maximum limit. Or a general way would be saying is you generally take a 10% exposure issuer wise, you know, in rough parlance, and roughly depending, let's say, so it varies, let's say if you are earning very well, you are at say early 40s, somebody like who has somebody like a person, let's say, who has a lot of investment in equities want to move to bond. So where I would say the risk ability and willingness to take risk is little high, and liquidity is not requirement is not imminent. You can choose to invest about 20 to 30% in double A kind of, 30 to 40% in A kind of, and keep a very small, let's say 20% in triple A. Now, somebody, let's say close to about 55 years of age, retiring another 5 years, where risk-taking ability, typically ability comes down, willingness can be high. I would suggest maybe go for 60 to 70% in AAA, and if still there is willingness to take risk, maybe invest in AA. So that, but any particular issuer or any particular instrument, don't go generally more than 10%.
Understood. So, and does it also vary dependent on the size of your portfolio? So, let's say a retail investor who is investing about a lakh in bonds versus a company's treasury having a few tens of crores or hundreds of crores investing. So, in both these cases, uh, the broad range that you suggested, 10 to 15%, remains the same, or does it changes?
So earlier it used to be difficult because the lot sizes in bond were high,
Yeah,
which would make it difficult. For example, some of the corporate bond, the lot size itself was a lakh of rupee.
yeah.
So you buy or sell in multiple of a lakh of rupees. So it was difficult. But thanks to our regulators, both RBI and SEBI, I think the lot size have come down a lot. So if you ask me, strictly speaking, from investment perspective, yes, this would stand okay. The 10 to 15% cap in allocation. Probably for corporate, I think we'll have to also take into account their liquidity needs, because their liquidity need may be more high than individual. So
Hmm.
probably which will, in terms of duration, overnight to liquid, probably will be more suitable for them. That's my observation.
Okay, okay, great. So, meanwhile, let's take a few questions. We received quite a few questions, and all those who are attending, please, if you have any questions for Ritesh, feel free to ask. And I'll just quickly ask few of the questions that we received. Okay. So, one of the question from Sudhendra is, any suggestions you have for people in mid 50s planning early retirement?
Oh, I think that's a very good question. So uh, before answering this question, I'm making some assumptions. I'm making an assumption that a mid 50s person probably would have all the major events in life like children's education, marriage, and all, covered up, and is largely looking for a where you can building a retirement corpus, and most of the life debts would be typically paid off usually by that age. That has been my observation. So I would suggest uh, a regular fixed income with minimal amount of capital risk is more suitable for the individual. So typical investment avenues would be Government of India bond, GSEC, uh, SGS, which is State Government of India Securities. So the difference between GSEC and SGS is one, GSECs are issued by the central government and SGS are issued by individual state government. But there is an implicit sovereign guarantee in state government bond also. So till now, I have not seen any state government bond default because there is an implicit sovereign guarantee, and the returns are 0.5% to 0.7% higher than the GC.
Okay.
Also, there are few AAA rated PSUs, like likes of Power Finance Corporation or Rural Electrification Corporation,
Yeah.
NABARD, SIDBI. So they offer close to about 6.5 to 7% interest as of now. So these are the few options one can look at. I would not advise them to go below AAA PSU in terms of credit rating.
Okay. Uh, okay. So another question is, can you share details of fixed income products and how they have performed during the years that have negative returns? By Shobit. So Shobit, I think we have already covered this. Maybe I can quickly uh, share this once again for your reference. Just one second.
So meanwhile, I'll request Karan if you can share some live polls we have prepared for the audience. Uh, if
Yeah. So just for your reference, Shobit, sharing this once again. So this was launched in October 2019, 2009. And till date, we have been able to deliver about 11.74% net returns post fees. And every single month has been profitable. There is no entry or exit load in this PMS. This is a pure arbitrage PMS. Yeah. Okay. Let's see. One of the questions is how much of one's portfolio should be in FDs, keeping in view the volatility of the market. This is by Arun. So, Arun, I think Ritesh has already covered this. I think if we compare FDs to mutual funds or specifically bonds, I think bonds taxation wise definitely has a huge advantage because then you will be it will come under the capital gains tax and not your personal income tax slabs. So that in itself is a big advantage in bonds. So as compared to FDs, definitely bonds is much better. And regarding your question of how much of one's portfolio should be in fixed income, I think that's totally dependent on person to person. Best is if you go to gullak.com, there's a risk profiling survey there. It will take less than 5 minutes, but it'll give you some indication of how much of equity versus debt you can hold. So that try taking one of those surveys. That is a much better approach because it depends on many factors, and it is very person specific, right? How much of allocation should be allocation to fixed income if you are an aggressive investor? Again, Shobit Tyagi has asked. So Shobit, again, it depends on person to person. But if you are an aggressive investor, I would say still about roughly 15 to 25 ballpark number is what you should definitely have um, in in this fixed income. Now, one of the question is also how safe are the bonds from OBPP platforms? So, Ritesh, your take on these platforms?
so, I think they are pretty safe, but nevertheless, one should do certain amount of background check. One, SEBI publishes the list of all OBPPs. They are also published by both the exchange, BSE as well as NSE. So before opening an account, I request all the investor to first check whether the concerned OBP has the requisite license from the regulator. Once they have the license from the regulator, I think rest assured all OBPPs would be genuine because that's their main line of business and they are very well regulated by SEBI and monitored by exchange. Having said that, not all OBPPs are same. Some OBPPs would have more inventory compared to others. Some OBPPs will offer direct linkages to exchange trading platforms. so they'll have more liquidity. So then you have to do some kind of market research that what is the inventory that is there on the OBB platform, whether they are offering connectivity to the exchange. Uh, some OBPPs require you to open a separate demat account for operational convenience with them. So I mean, these are the few factors that would go into consideration. But largely, if they are issued license by SEBI, then we can rest be assured that they are all genuine.
Okay. So we received quite a few questions related to our small cases. So I'm afraid we won't be able to take those questions in this specific because we want to keep our focus on fixed income. However, we'll be happy to take these questions in our monthly webinars. Yeah, there's another question from Guna about I-alpha. So this we have already taken. Okay, so I think we covered all the questions that we got from the registration, and I'll quickly take question related to what is the minimum investment required to invest in fixed income and what is the rate? Devendra Mehta. So I think I can talk about our product, fixed income product, which goes by the name of I-alpha. Because it is a PMS, the minimum investment required is 50 lakhs in this specific product. And the rate of interest, we obviously we cannot guarantee any rate of interest, but historically what we have given, I've already informed, 11.74 is the post-fee return that we have been able to deliver in last 16, 17 years, and pretty consistent portfolio that we have. Okay. Q&A and in chat. Okay, I think those are the questions. Ritesh, you want to talk about the survey results? Anything on that?
So I think close to 1/3 of the audience they already invest in bonds is from the poll question that I get. I want to highlight one. So every fixed income product per se would have its own nuances. I'll just try to explain it with an example. Uh, just one second, let me share my screen. So here I'm taking an example of a zero coupon bond. So any zero coupon bond, so zero coupon bonds are like deep discounted bonds. So they are issued at a lower price and there are no regular coupon payments, so no regular interest payment. So you get one final payment at the maturity, very much like your cumulative fixed deposits, where you invest today and you get, let's say, invest for 3 years and you get the principal plus the interest after 3 years. Now, if we let's say take an example of a 2035, it's a 10-year zero coupon bond which is issued at rupees 40 and the maturity value is rupees 100, and you invest, let's say, 10 lakh. On maturity you earn 25 lakhs. I mean, the cash flow that you get is 25 lakh. So you basically earn close to about 15 lakh. Now, with this zero coupon bond, the entire gain of 15 lakh is considered as long-term capital gain, and it is taxed at 12.5%, which comes to about 1.9 lakh. So your net corpus at the end of 10 year is 23 lakhs with a healthy CAGR of 8.7%. Now, let's say instead of that, we would have invested the same amount, 10 lakh in an FD. Considering the annual tax rate of 30%, the entire corpus would have been at 16.3 lakh compared to 23.1 lakh investing in zero coupon bond. So FD CAGR would be 4.9% vis-a-vis 8.7% in zero coupon bond. So zero coupon bond will yield you 3.8% higher post-tax return. So these are the few nuances when it comes to fixed income securities. Uh, every security or every class or category of security has some individual nuances. So the point is that if we leave it to the expert, I think it is easier to manage.
It's quite interesting. Over a 10-year period, you showed how zero coupon bonds can deliver almost 50% higher, right? 16 lakh versus a 23 lakh. So that's the difference of almost 50% higher corpus in 10 years if you invest in zero coupon bonds versus FDs. Yeah, quite
Yeah,
a big difference there.
yeah. So if we see here, 8.7% vis-a-vis 4.9. So almost, I mean, little lower than 50%, but yeah, that's the kind of advantage we get.
Yeah, interesting. Interesting. Okay, okay. So, Ritesh, we have any more poll questions also? I think we have a few more poll questions. By the way, there's a question from Rakesh Shah about can NRIs invest? So, Rakesh ji, if you are asking specifically about our I Alpha product, because this is an arbitrage product in which we do arbitrage between futures and futures, unfortunately, NRIs cannot invest in this specific product, I Alpha. But we do have another product by the name of Long Alpha that is on the equities side. So we can definitely, I think we have your details. We'll be happy to connect with you and explain about the other products. Long Alpha also, and we have one arbitrage product for NRIs. So our team will get in touch with you and explain you what are the products we have specifically for NRIs. Yeah.
So I think we have one more question from the audience.
Yeah.
Sachin has written, I've invested in post office. Is it safe to shift in bonds?
Yeah.
So, uh, yeah, traditionally, there have been a lot of investments via various schemes that the government announced, and post office's investment is also one of the scheme. If we are talking pure from the risk perspective, I think if you invest in AAA rated bond or AA rated bond, largely uh, they are considered to be safer investment. Obviously, everything has its own risk, but if we think about the parlance, then usually AAA rated and AA rated instruments or companies have proven in time to be stable, you know. So in that term, yes, it is definitely a good shift if you want to move to bond. But again, this question will also become at what point of life stage one is in, and what is the individual investor's risk appetite versus return expectation. So somebody who is young, started working, probably can look to take higher exposure on the direct bond. But somebody who is at the fag end of the career and wants some amount of flight to some amount of safety money can invest in post office also. That's absolutely okay. But over a period of time, as I mentioned, bonds in last 3 4 years, I have seen more demand coming from investors, especially in last 4 to 5 years. And if you talk about the corporate bond market in general, I think the overall market has grown at a very healthy pace of 10% year on year. So yeah. So we have few poll questions. I would request the audience if they can kindly answer. We will also share a survey link after this podcast. Uh, it's a small survey where we want to gauge uh, investor demands in various fixed income instrument depending upon the return expectation, the risk appetite, and what will be your expectation from ST as fund manager, what kind of product or so it's a small survey. Probably this will help us to design or customize certain PMS strategies for our larger investor base, in addition to IALPA, of course.
And for those who are interested and who want maybe some personalized information about our product or in general about bonds investing, please feel free to get in touch with us. Here's the number. You can just maybe WhatsApp on this number and coordinate about the timings, and then you can connect with us. So we are happy to get on a call and explain in more detail about specifically about our products or in general about investing in fixed income and bonds. This is quite interesting. The third question, what post-tax returns do you target? So 6 to 7% is zero, whereas 7 to 8%, roughly 50% expect 7 to 8%, and another 50% expect 8+% from their fixed income portfolio. However, Ritesh, as you showed, FDs doesn't give you the 7 to 8% kind of post-tax returns, right? They give you about 4.5, below 5%,
Below 5%, yeah.
below 5% returns, and a huge majority of us actually invest in FDs. So quite interesting. Uh,
So I think over a period of time, we have seen people, we have seen the investor behavior. They are moving from traditional fixed deposit. There was a news article by a leading finance newspaper yesterday, where they actually showed that there is an increasing trend to move away from traditional fixed deposit to other investment products like mutual fund and PMS. So I think earlier our investor base didn't have that many options. So that's the reason traditionally they were investing in fixed deposit. But with regulatory approach being making bonds available to individual investors and investor awareness, of course, I think last 3 4 years we have seen aggressive investment in bond market, and hopefully the trend will continue over next few years. So just taking from the one of the poll question that we had, how much extra return over FDs or debt mutual fund would make you choose bond PMS? So majority are there between 1.25% to 1.5%. So this is exactly what I demonstrated in my example earlier, that a typical PMS with a blended rate of 9% would give you a post-tax return of around 7. Now this you compare with a 5% FD rate of return, we are already there at plus 2% post-tax return. So yeah.
okay, then I think this is the last question we have. uh, what do you most want ST's bond service to deliver? So, see, guys, we already have this arbitrage fund we have been running, but we are also considering launching something on the lines of bond. What can we do in this specific area? And that's why we wanted your feedback on what exactly is the, if we were to deliver some product related to bonds, what exactly is the criteria that you will judge us on, whether it's better returns, whether it's monthly income, tax saving, easy digital process to invest and withdraw, and capital safety. So if you can please answer this last question. Great. So roughly everyone has said they want better returns and capital safety, and two-thirds of the people have said that steady monthly income, tax saving, and easy digital process are also important for them. Okay, okay. Thank you. Okay. So that with that we come to the end of this specific webinar. I thank all the participants for attending. Hopefully, we were able to generate some value, something you got out of this specific webinar. And thank you, Ritesh, for doing this for us.
Thank you, Vivek.
Thanks a lot, everyone.
Thank you, Vivek, and thank you everybody for listening.